We're in the eye of this bubble valuation storm. Around us, we've got 150 mile per hour winds, category 5 at this point, and they're gonna come to us too. We just don't know when, but we know it's going to happen, meaning manipulation is always trumped over time by market forces.
Hey friends, thanks so much for tuning in. You know how much it means to us. Hey, I want to just say a couple of things first before we get started with our friend Dan Kurz, who Bill Holter speaks extremely highly of. I want to thank everybody for bearing with us as we build the new and improved, much faster loading sgtreport.com. I think you guys are seeing some differences already. It looks better, it's more legible, and it is loading lickety-split fast. So thank you to our patrons, and thank you to so many of our visitors on a daily basis. We're also trying to bring back a nice comments section so we can get the conversation started again. I do miss that aspect of SGT Report. And please do support our premier sponsor, SD Bullion. Click the banner at the top of SGT Report for this month's special offer, only 39 cents over spot for the beautiful 1-ounce SD Bullion Silver Freedom rounds. Use the code SGT3. We love those guys at SD Bullion, and we really appreciate their support. We certainly appreciate your support too. On the line right now, we're going to talk economics and the bubble that is. Boy, it's the eye of the storm, according to our friend Dan Kurz from DKanalytics.com. Dan, welcome.
Thank you very much, Sean. Pleasure to be here.
Well, it's a pleasure to have you. And, our mutual friend Bill Holter does speak very highly of you. He goes to DK Analytics and often quotes you, and I think sometimes you quote him. We're just
Absolutely.
a nice little community of free thinkers here and anti-Federal Reserve central banking people, aren't we?
Yes, and Bill and his colleague are extremely well suited to man the post, if you will, of free market capitalism and constitution. And I think that's what's so missing. And I think one of the reasons we're lulled into this stupor, which you referred to, and I do, the eye of the storm, is probably why we don't have too many people wondering why the bottom hasn't fallen out yet, because we're in the eye of a storm. And when that ends, it will happen. And it's not a question of if, it's only a question of when. And there are amazing opportunities to bring capital home, and there are big risks if you stay fully exposed to drastically overvalued bonds and stocks, as a general statement.
All right, and just to be clear, the eye of the storm is the fact that everyone is used to these bubble valuations and they think they're going to go on forever. Boy, we just saw that change real fast in the crypto space. Hopefully it'll bounce back, but I think it's coming for stocks and bonds. But, before we get into that, did you see this line item today from Zero Hedge? This is quite amusing. Being as though the powers that be tell us gold is a barbarous relic, Russian plane loses 3 tons of gold on takeoff. There's gold bars all over the runway in Russia there. I'll just show some of those pictures. I find it very amusing. Gold is not a barbarous relic quite yet, is it, Dan?
No, absolutely not, Sean. It's real money. It's been established as that over thousands of years. I posted a piece myself a couple months ago on real money versus cryptos. I have a real money historical stance there. And I think that when this whole thing comes apart at the seams, we are going to revisit real money. And that is something that has value on its own, that is divisible, and frankly, that is recognizable throughout the world. And that day will also come. But I think in the interim, we should focus, if I may say this, on getting out of Dodge, at least to a substantial degree, as concerns drastically overvalued bonds and stocks.
Well, let's talk about that. The eye of the storm. We hear trumpeted frequently now on CNBC and through the mainstream media that it's all about PE multiple expansion. It's not about earnings per share growth. I mean, look what Amazon has gotten away with for so very long. They don't even have to report earnings, and they're rewarded with monster multiple expansion with their PE and their stock price. It's a dangerous cocktail, isn't it?
It is indeed, and obviously, if you have a P in the first place, first you have to have earnings, and typically Amazon has not brought that either. But that's neither here nor there. But your take is very, very spot on, Sean. It is about multiple expansion if we are referring to outsized stock returns. All right. And that whole topic builds on something very, very important, namely, where are we with valuations in the first place? We're at 26 times GAAP S&P 500 earnings per share. And if we look back at history, and history is a guide, and economics will eventually trump politics, even the flavor of today, which is not conducive, obviously, to an optimal growth trajectory. But if we take a look at historical periods, and we look at the S&P 500, and I sent you a chart along those lines, where we break down decades of returns over 8 decades, starting with the 40s. What we find are 3 decades where we had double-digit returns from the S&P 500. That is per annum stock price gains coupled with dividend income. And those three decades were the 50s, the 80s, and the 90s. And those same 3 decades had periods in which EPS growth and GDP growth were quite pedestrian. In fact, the two over time are almost one and the same. Think about it. You can't outgrow GDP forever, and you can't keep doing stock buybacks, and you don't have stockholders benefiting more than than governments or employees forever. So it's pretty simple to understand, right? But if we step back and look at valuations, and we look at the 50s, the 80s, and the 90s, where we had PE expansions, we noticed that it had relatively little to do with EPS growth or GDP growth. What it had a lot to do with is that we entered those periods, those growth decades, in terms of outsized gains from the stock market from high interest rates. So the interest rate reduction is what facilitated the PE expansion, and the PEs in those decades tended to start at a relatively low level, and we were able to advance from that. Today, for example, in the 00 years, we had a PE compression, right? And then after the 08 debacle, the financial crisis, we had QE and ZERP and even NERP. We had interest rates keep plummeting, and lo and behold, we got higher stock prices because they are, in fact, discounted estimates of future earnings, which brings us to the net present value of the Standard & Poor's 500, perhaps also something interesting to look at.
Yeah, that's interesting because the interest rates, as everybody knows, can't go any lower. And in fact, they're trying to raise the interest rates now. So you're saying interest rates reduction facilitated rising stock prices in the past, correct? It leads me to believe that the only thing facilitating rising stock prices now is high-frequency trading and computer algorithms. It's not a real market.
I couldn't agree with you more, Sean. You could state it however you like, but we don't have price discovery, whether it's algos, whether it's technicians, whatever it is. We don't have a market where price is determined. The ultimate price in free market capitalism is what we pay for assets, right? That's an indication of where to invest or where to disinvest. And this has been thoroughly polluted, turned upside down, taken out by central bankers or central planners with their own agendas that obviously don't line up with a sane economy and good growth prospects. But yes, you're absolutely correct. We don't have it. But history suggests, and this is the point, brings us back to the eye of the storm. However, the prices are pushed up, or I would argue suppressed in the case of precious metals, over time, economics will trump politics. We're in the eye of this bubble valuation storm. Around us, we've got 130, 150 mile per hour winds, category 5 at this point, and they're gonna come to us too. We just don't know when, but we know it's going to happen, meaning manipulation is always trumped over time by market forces, even if they've been so throttled as has been the case since, in essence, 08, 09.
Let me ask you about Donald Trump. Do you think we've been given a reprieve because he's in the White House? Now, look, I fully understand that the debt is going to increase now at an even greater rate than it has even under Obama. But do you think we've been given a reprieve by the world because there's a collective sigh of relief that the witch isn't in the White House, Hillary Clinton, the Clinton Foundation, and their epic crimes? Because it seems like Donald Trump is doing many things that the witch would never do. And as you and I both know, she was a Rothschild agent. She was Rothschild's choice for president. I think she would have taken our economy and our nation right into the dumpster at hyper speed. What's your thought?
I think you raise an excellent point. I have to fess up to the fact that I voted for Donald Trump, but with strong reservations. I believe that Donald Trump obviously is much more conducive to a nation state, to national sovereignty, most especially, which at the end of the day is very important if you're going to have representative government and any chance to have equity for the actual citizens of a country. And this is true also in Europe, as we face a similar situation there. I think Donald Trump is a reprieve in the sense that he's not doubling down on eviscerating our Bill of Rights to the degree that Hillary Clinton would have, especially the First Amendment, the Second Amendment. In that sense, absolutely. The fact that he loves the United States, I think, is also clear. And he doesn't want to have us be, outsourced to the UN or some other kind of world or global government. So far, so good. At the same time, I feel and I fear that he and the Republicans, run by the rhinos, Republicans in name only, are missing this key chance as they control the entire federal government, much the same at the state level and state legislatures. We should be optimizing or focusing on cutting the size of government, on cutting government spending, on taking these bureaucratic institutions, which all report to him, out as far as we can see. 90 to 95% of the laws in this country don't get made by the legislative branch anymore. They get made by the administrative state, the deep state, if you will. And that is neither constitutional nor is it representative. And I just wonder if on those key fronts, on spending discipline, on getting rid of a lot of these Marxist bureaucrats that in essence want to eviscerate the Bill of Rights and individual liberty and the whole protections, whether Donald Trump is not dropping the ball. We're not capitalizing on the other side of the equation. And that's what I fear is what is going on.
What are your thoughts on the tariffs? He's definitely playing some hardball. He's not a globalist like Hillary. I don't believe he is. He's certainly not acting like a globalist. You mentioned that he doesn't want us involved in the UN. He's talked about getting out of NATO. He's talked about getting us, and did get us out of the Paris Accord, the Climate Change Accord, doing some good things, I think, for the country, if you care about the country in which you live, the United States, which I do. But what do you make of the tariffs? Good move?
No, I actually think just the opposite. I think if you take a look at our huge import dependency, much of it isn't the result of the rest of the world not playing fair. I mean, Germany and Japan have had export surpluses with very strong currencies on balance and even higher wage rates than we have. So it can't be, our currency is too strong or our wages are too high. I think it's twofold. It's that we're not optimizing our constitution over here. We've got insanity and regulatory insanity, litigation insanity, 3 times almost the cost of what Europe has. And we're not really tackling the stuff at home. But that doesn't make for a convenient soundbite, right? And that's part of the problem. It's easier to go after the big bad boys overseas or countries that are playing unfairly. Well, if that's the case, how is it, and I repeat, that countries like Germany and Japan over decades with high wages, with strong currencies, have had trade surpluses? How is it that America, after taking its currency down since the end of Bretton Woods, about 70-80% since then against most other major currencies, if that works and we have a lower currency, why don't we have a budget surplus? In other words, going at it in a tariff fashion, if you will, is in effect a huge tax on low-income Americans. It's also a tax on all the companies that are going to now have to pay 20, 30% more for steel and aluminum and God knows what else that they use to manufacture chillers, air conditioners, if you will, washing machines, Boeings.
But let me jump in and ask you a question and play devil's advocate just on the steel. Because we know China is acting a lot and has been acting a lot like Amazon, undercutting the competition to hell with the profit margins. And if his goal is to bring industry back, maybe we need to start producing our own steel. So to that end, it is a positive move in my mind.
Well, I think the intention may be good, but take a look at Wilbur Ross. Take a look at his cabinet. Take a look at where these guys made so much money. In textile and in steel, they ran to the government, they got price shields, they got tariff protection. And by the way, there are tariffs in the United States on 12,000 different imports. It's not as if we don't have tariffs. But I think this is the wrong emphasis. If you want to drive demand for steel, and about 70% of the steel in America is produced by America, then increase the vibrancy of those industries which consume steel. They don't need more expensive steel. They need cheaper steel. So if you want to enrich or act as a crony and help a very slim sliver of our aggregate industry at the expense of the rest and of consumers that end up, John, who collects this tariff? This tariff is collected by the U.S. government. I thought we were into tax reduction, not into tax increases. And who benefits from it? Not Maytag, not Whirlpool, not GE, not Caterpillar, not the people that manufacture here and use a lot. The significant part of their cost of goods sold, is stuff like steel and aluminum, the metal benders. So I think it would be much better if we could focus on true regulatory reform, cutting the size of outfits like the EPA and the Department of Non-Energy and what have you. And yes, he's working on that, but make that the focus. Use this control that the Republicans have at the federal and the state level to take these bureaucracies out and then see what kind of, we have tax relief, that's great. But if we end up spending much more, we have larger deficits, we're heavily indebted, then we might have a much higher interest rate tab, which could more than offset the reduction in taxes. So I'm not so convinced that all said and done, it's a very good mixture, a policy mix.
Yeah, the consumer will pay more. Japan automakers warn of higher prices following Trump's tariffs. But you know what? The flip side of that is maybe people should start buying fewer Camrys and Accords and more of the cars. Well, and actually, a lot of those cars are made in this country because, you're right. Japan moved a lot of their plants right down to Georgia, I think. I didn't know that we make 70% of the steel we use in this country. Is that a fact?
Yeah.
I didn't know that. All right, well, you set me straight on that. That's a good thing.
But you know what? If we want to increase domestic production, we shouldn't increase the cost of goods sold with such important items such as steel and aluminum. And moreover, if we want to export competitively, those costs are on board. And the ironic thing is I don't think that's going to help us shrink our trade deficit, which in fact is expanding, not shrinking. I just believe in, yes, free market capitalism. This country has the ultimate mix of geography, the best constitution, that if we just focused on tending to the store better at home, we could navigate and overcome these issues that you correctly address.
I 100% agree. And you know what? I was reading an article that said the United States of America is the country best positioned on the planet to be sovereign and to not import from anybody. We can make and produce everything we need in this country. That is a very, very rare asset. Most countries can't claim the same. Canada's a joke. Canada can't do that. They're great at producing energy, but they can't produce much of anything else.
Correct, and it's too cold. No other country has the kind of waterways, the coal assets, the fertile plains, the Mississippi Delta with no ice issues. This country, from the Constitution to the geography, is just to the people that are here, is very specially endowed. And then Trump trying to get it back up and running, that is the correct way to look at it. In that sense, I am glad as anything, glad as hell that, as you state, the witch isn't in the White House, because then it really would have been all over.
Yeah, it would have been a
I
nail in the
hope.
coffin. It would have been a
Yeah.
final nail in the coffin, which is her goal. And you know what? This asset-rich, commodity-rich nation that you just described is what the Rothschilds wanted. I mean, it's this whole Agenda 21, Agenda 2030 thing: get the people off the land, herd them into big cities, execute the eugenics programs, cull the population. So we really, truly have been given a reprieve because President Trump is in the Oval Office instead of the witch, who is Rothschild's choice. That's my opinion. And we can move on here in a second, but your thoughts on that? I think we have been given a huge reprieve in all sorts of different ways.
I agree with you, Sean, and I just hope that Donald Trump is mindful of not only the huge chance that the red states have given him, and thank God for the red states, but that he focuses at the end of the day on things that will increase the rule of law, constitutional fidelity, decrease cronyism, not ramp it up. I'm worried about the people in his cabinet. I sometimes worry about whether his understanding of the Constitution is too shallow. But this time around, we are faced with two parties that are much more alike than not in terms of their agenda with spending. All right. And that really worries me, because we are out of control. The country is $68 trillion in debt. A 1 percentage point increase in the interest rate is $680 billion in a short time of higher interest expense. So if we're looking at, the 13.2 trillion in consumer debt as well, corporations that have gone from 3.5 trillion to $6 trillion, buying back stocks instead of focusing on organic growth, which is, the benefit of the top management, the C-suite, which gets to get options that are fixed price or under the actual price of the share when they're issued, and they get to reinvest the retained earnings, what they don't pay out in dividends, and get this free uptake every year. I'm worried about what I call a toxic public policy stew, that even someone like Donald Trump, with the best of intentions, which I don't know if he fully really gets, if I could be so frank, whether he can change what has already occurred in time to wrest control back in the direction of constitutionalism and free market capitalism. At the same time, even if he does, our valuations are so rich on bonds and stocks that I keep talking about the eye of a storm. Even if he did all the right things, we are going to have a recession. We're overdue for one. We've had extremely artificial and weak GDP growth. And by the way, Sean, a lot of people don't know this, but Standard & Poor's 500 earnings per share from the '06 peak of $82 to the '17 peak only advanced by 2.7% per annum. Only 2.7%. And we're sitting here valuing these earnings at 26 times, and historical GAAP numbers. And any time a recession hits, it knocks earnings off of a pedestal, a very artificial one here, to the tune of 50, 60, 70, 80%. In '07 and '08, we lost 70, 80% of peak earnings. Good, we had big BAF accounting, but this time we have a country loaded up to the gills of debt. We have less property right protections. We've had corporations that haven't had organic growth. So we could have an even more difficult earnings recovery. And if one pulls this all together and looks at a valuation and assumes some kind of adult instead of childish discount rates, in other words, taking those earnings in the future and discounting them back to the present, then one can quickly come up with a Standard & Poor's 500 valuation that is between 40 and 60 and even 80% below where it stands today.
Hey, Dan, actually, one thing that I wanted to ask you before I forget is this interbank lending chart that just shows that we're at a 50-year low in interbank lending. So what are the banks so afraid of? And does that chart worry you?
Absolutely. I think it's called counterparty risk. I think it's called they don't trust each other's books. If you go to the BIS, right, the central bank of central banks, and you go onto their webpage, and I have this in the slideshow that you've referenced here a couple times, and you go and take a look at what kind of over-the-counter, off-balance sheet interest rate derivatives there is outstanding in the world that is held by the big money center banks. It totals over $400 trillion, right? And that, in essence, is a bet on just one thing. That one thing is that interest rates stay low or go lower. If that doesn't happen, all these banks will be incapable of making good. I mean, think of it this way. If most people take on debt and they want to insure themselves against higher interest expense, right? And then they enter these deals. The banks are the other side of the transaction. They're making the bet that interest rates stay low and go lower. Well, they've got a $400 trillion exposure stating that they damn well better stay lower or their gooses are cooked. I think that with the uptick in interest rates, is what has got them worried. And if this continues, that could be the black swan that takes the whole thing down.
Yeah,
that
agreed.
Takes us out of the eye of the storm and puts us into the storm.
Yeah, couldn't agree more. Well, let me ask you this. As we finish up this conversation, the eye of the storm is the name of the interview, and I want to ask your opinion. You know how many of these pension plans in this country are on the verge of total collapse. You know how inflated the stock market is, the bond market. If you were running one of these pension plans, Dan, given everything that you've just said, given your concerns about the bubble valuations, what would you do to try to prevent the pension plan you were running from a total collapse? Basically, what I'm asking is, what would you suggest the people listening do as it pertains to their own assets?
Great question, and that really drives the whole thing home, Sean. First of all, if you're running a pension fund, you have various statutes and regulations that you have to comply with, which unfortunately will not allow you, generally speaking, to even own physical gold, only paper gold or silver. And in essence, you're tied to being invested, meaning you can't have cash balances that are large, which in turn condemns you to, in essence, being on board when stock and bond markets head south. And that's a question of when, not if. If I can speak more loosely as a private individual with monies that he has at his disposal that are not locked up in a defined benefit plan, or to some degree even restrictions in the defined contribution plans, then I would say get the heck out of harm's way. Sell where you can or trim strongly very high PE stocks and bonds almost across the board, also in the junk bonds. The spread between 30-year treasuries, 10-year treasuries, and junk bonds is too small. And we're going to see those yields jump into the teens, into the high teens, maybe even into the 20s. So what I would do is try to trim my exposure wherever I could to overvalued bonds and stocks, and in essence, that's most of them. And then I would go into safe cash. What's safe cash? Well, T-bills. Why is it safe? Because you can't be bailed in, you can't be, cut off with bank runs, and because the government can protect you because it can print the money to make you whole. And it also doesn't have interest rate risk, duration risk. You're not going to lose like a 10-year treasury if the yield goes from 3% to 5 or 7, where those holders are going to get clocked. So in essence, go into safe cash where you can. If you can buy physical gold and silver, do that, and nibble on scarce real assets, vital scarcity assets, especially in the energy and in the ag realm, because those are the things that always get more expensive when things get really ugly.
All right. Our guest has been Dan Kurz from DKAnalytics.com. Dan, thanks so much, buddy.
Thank you very much, Sean.
All right, my pleasure. And guys, thank you so much for your support at the new and improved fasterloadingsgtreport.com, thephaser.com, and thelibertymill.com. Real news 24/7. God bless.
You have to realize Your future is at stake. Your life depends on stopping this coup. Every American. What the deep state is doing is a life and death matter.